The phrase debt is the root of all evils encapsulates a pervasive belief in society about the pernicious nature of debt. Indeed, being in debt can feel like a form of bondage, constraining one's financial freedom and subjecting them to the demands of creditors. The United States' staggering national debt, surpassing $34 trillion, underscores the magnitude of this issue. However, while debt undoubtedly poses significant challenges, particularly for individuals grappling with its burdensome weight, it's important to recognize that debt can also serve as a powerful tool for wealth creation and economic advancement. Here are 5 ways the wealthy make money from debts. 1. Real estate investment and leveraging mortgages. Real estate investment is a staple wealth-building strategy for affluent individuals. By leveraging mortgages, investors can amplify their purchasing power and acquire properties with relatively little initial capital. Here's how it works. An investor identifies a property with strong growth potential or rental income prospects. They then secure a mortgage, typically covering 80% of the property's value, and make a down payment for the remaining 20%. Over time, as the property appreciates and rental income accrues, the investor builds equity. Moreover, refinancing strategies allow investors to extract equity from properties, providing capital for additional investments or diversification into other asset classes. 2. Debt financing for business expansion. Entrepreneurs and business owners often rely on debt financing to fuel growth initiatives and capitalize on expansion opportunities. Bank loans, lines of credit, and corporate bonds provide access to capital without diluting ownership or relinquishing control. Here's how it works. A business identifies opportunities for expansion, such as entering new markets, launching new products, or acquiring competitors. They then secure debt financing to fund these initiatives, leveraging existing assets or future cash flows as collateral. Debt financing enables businesses to accelerate growth, enhance operational efficiency, and gain a competitive edge. 3. Leveraged investments and hedge funds. High net worth individuals often allocate capital to hedge funds and private equity firms that employ leverage to enhance returns. Leveraged investments allow investors to amplify gains by borrowing capital to magnify their investment positions. Hedge funds employ various strategies, including long-short equity, global macro, and event-driven investing, to capitalize on market inefficiencies and generate alpha. Here's how it works. A hedge fund manager identifies opportunities for profit across different asset classes or markets. They then use leverage to amplify their investment positions, potentially magnifying returns. While leverage increases potential returns, it also amplifies risk, necessitating sophisticated risk management and due diligence. Hedge funds are typically suitable for accredited investors with a high tolerance for risk and a long-term investment horizon. 4. Forex trading and currency speculation. Forex trading offers affluent individuals the opportunity to profit from fluctuations in currency values using leverage. Margin accounts enable traders to control larger positions with a relatively small amount of capital, amplifying potential gains. Here's how it works. A Forex trader analyzes macroeconomic trends, geopolitical events, and technical indicators to predict currency movements. They then use leverage to amplify their trading positions, potentially maximizing profits. However, Forex trading involves substantial risks, including volatility, liquidity risk, and geopolitical uncertainty, necessitating a disciplined approach and robust risk management framework. Forex trading is suitable for experienced traders with a deep understanding of market dynamics and a willingness to accept the inherent risks involved. 5. Leveraged buyouts and private equity deals. Private equity firms specialize in leveraged buyouts, acquiring companies using a combination of equity and debt financing. Leveraged buyouts allow investors to maximize returns by utilizing the target company's assets and cash flows to enhance operational efficiency and drive growth. Here's how it works. A private equity firm identifies a target company with strong growth potential or undervalued assets. They then structure a leveraged buyout using a combination of equity from investors and debt financing from lenders. Through strategic restructuring, cost optimization, and revenue enhancement initiatives, private equity investors aim to unlock value and generate outsized returns for their investors. However, leveraged buyouts entail significant execution risk and require deep industry expertise and operational capabilities to succeed. In conclusion, while debt certainly carries inherent risks and challenges, it would be misguided to view it solely through a lens of negativity. Yes, debt can be burdensome, trapping individuals in a cycle of financial hardship and constraining economic growth.